Hayden Locke, President and CEO of Marimaca Copper. We are developing the Marimaca Oxide project in northern Chile, and we are really reaching an inflection point of our development as we transition from an explorer to a developer, about to deliver our DFS, which we expect will continue to show that this is a project with industry-leading capex and exceptional return on invested capital metrics. So an exciting time for us as a company.
Good to be with you, Hayden. It's Hugh, Agro, President and CEO of Revival Gold. We're a developer in the western United States with 2 projects and a PEA just recently filed. We're in the development phase on about 6 million ounces of gold in the U.S.
Guys, thanks so much for joining us today. We're going to talk today about the realities of junior mining and specifically around the kind of inflection points where companies made decisions which kind of dramatically changed their fortune, so that they could go on to tell me that they're undervalued and they will be growing. But let's look at that, okay? So Hayden, I'm going to start with you. When you joined as CEO, you walked in there, you had to evaluate things. Talk us through, what you saw and what you realized very quickly you needed to do.
Yeah, 5 years ago now. It's gone very quickly being involved with Marimaca for that long. When I first joined, it on paper at least, it was a very nice asset, but relatively small. It had all of these great attributes that I've referred to ad nauseum on calls with you over the past couple of years. But it was pretty clear that we needed to try to expand the potential scale of the opportunity, and that's really done through exploration. I've said it multiple times to you previously, scale for scale's sake doesn't help in the mining industry, in my view, and you see a lot of projects going for scale because it helps them underpin a better return on invested capital metrics. But there is a point where having a bit of scale is very beneficial in a large industrial scale project. So that was really a clear strategy. I spent a week on site with our geologist, and I was, pretty impressed with his views on what the opportunity set there was with just an additional bit of money spent. So really our focus was on exploration and trying to get to that scale, which really makes us globally significant, or at least at the small end of globally significant.
Right, and just tell me a little bit about the kind of internal discussions there. But I mean, clearly most juniors want to talk about, we just need to get bigger. So when you're saying scale for the sake of scale is not necessarily always good, most geologists say we want to drill the bejesus out of this thing, so let's get going. So what's the kind of the nuance there?
I think there's a trade-off in the time taken to drill out everything and the costs taken to do that. At some point, as a junior company with no cash flow, you've got to stop going back to the market and raising more money and diluting your shareholders, in my view. I'm of the view that you drill until you've got a project which is of a scale that you can take into production, and you can talk to the full financing universe and attract the right financing partners, but also have enough scale and enough mine life that you're protected from, and I'm sure we'll cover this, the problems that inevitably occur as you go through the development cycle of building a mine and taking a project into production.
We will talk about Chile for sure. And Hugh, for you, obviously, you were kind of running things a certain way, and then last year kind of made a pretty big change in your to the way things were planned. Made an acquisition. Why did you feel you needed to do that in a tricky market?
Actually, let me step back to the start of Revival Gold and our approach. It's very much in line with what Hayden's been talking about. Actually, I think this Australian model of, in effect, bootstrapping projects is the right way to go in a capital-constrained market. In Canada, traditionally, we've pursued these big, large drill-off projects and the hope and prayer that some major will come along and buy us. But the risk with that is huge. The risk is that you can't get it funded properly, and by that I mean too much dilution, again, something Hayden spoke to, but that the major doesn't turn up or something else comes along. And so these are big capital projects, and I think the right way to approach them, and I think what the industry has learned, again, the Australian model, is to take a phased approach. And that's what Revival Gold has done with our Bear Track Arnett project in Idaho, our founding project there, 4.6 million ounces of gold. But the PFS is with respect to the first phase heap leach on that project. We'll continue to explore. Again, I think it is important that you have a project with scale, again, picking up on Aiden's point, that is something that can be a meaningful, long-lived asset. And in the case of our Mercer project you alluded to, recently acquired about a year ago, what's attractive about that is that it fits with our portfolio. Again, this phased approach, low capital, low risk, in a capital constrained environment, we want to move to free cash flow faster, and this project will allow us to do that.
But isn't that the capital telling you what risk profile they want? So therefore, you must change the way that you've traditionally done mining. Do you think they're right and you guys were wrong?
No, I think you're absolutely right. And I don't think either of us are wrong. I think we're on the right path here in developing these projects with relatively modest capital, not trying to carve out something that's going to be billions of dollars, but something that could go into production relatively soon and lowers the risk of equity dilution and the cost to shareholders of equity dilution.
Right. Okay. But what does that conversation look like internally initially? Was there identification of a problem, which was no one's interested in this type of gold project with this type of profile. We must talk about getting into production sooner, or getting into the possibility of nearer term revenue. When did that moment happen? What was the sort of the indicator or the moment where that light switched on?
Yeah, so I'll jump back in here, Matt. For us, it started when we founded the company in 2017. We specifically went to brownfield sites where we have low capital, low technical risk around restarting, because we recognized that capital was constrained. Remember, 2016, 2017, we're still down at $1,000 gold-ish, and capital is constrained. So we recognized at that point, and we said, look, the oil industry has already figured this out. They're already taking a phased approach to development. We were a little bit ahead of the curve with that, and I think the mining industry is going there. And the success of Marimaca, I think the success of Revival Gold in building up a portfolio, now the one of the largest development portfolios in the United States, but a realistic path forward. I think that's testament to the success of that kind of strategy.
Okay, and Hayden, just wanted to ask this. I mean, you may be about to say the same thing, but if I look back at what you did, you said, right, okay, we're going to. It's a small project, small but perfectly formed, but we need to make it a little bit bigger. That kind of got you strategic investors on board. It got you money
Exactly.
on board to allow you to do what you're doing now, which is picking up more land package. So was it a means to an end?
Look, I think it was. You need to have the scale to attract the next phase of investors. You can make it through, and you'll find people who will put money into small scale development strategies. We've seen them struggle, time and time again in the mining industry. But I think going back to a point that Hugh made on the strategy in Canada, and I've experienced this, was, drill it out and then hope that there's a buyer. I think the strategy that we're both employing, by the sounds of it, is not, it doesn't necessarily reduce the opportunity for us to sell. But in my experience, people want to buy you a lot more when you're actually going with a plan A of building it and taking it into production, and you've proven a de-risked pathway to doing that. At the end of the day, we're custodians of our shareholders' money, and our objective is to make our shareholders money, whether that be sell the asset or take it through to production. Whatever the best risk-adjusted return is for our shareholders, that's what we're aiming to do. And I think having a clear development plan and saying, in the absence of a compelling offer, our intention is to build this and take it into production and become a business that produces cash flow for our shareholders, is the right solution.
But it becomes back to that phase component, right? If you're going to build this thing out and drill to the edge of the envelope, and it becomes a $1 billion plus capex project, that money I don't think is there at the moment. So again, talk to that.
Yeah. Well, so in the copper space, very much so, we've seen there's a huge pipeline of copper projects. And in fact, I think I said to you, I sat in an RBC conference where it was the developer conference. And I think the average capital cost to production for those copper projects was over $2 billion. There was only 2 projects in the whole room that were sub $1 billion of capex. One was us and one was Hot Chili. And Hot Chili's now back above $1 billion. Necessarily, unless you have a gold price like what we're seeing at the moment, where money is very much attracted to the gold sector given what's going on. Copper, not so much at this point. You have to have a strategic partner, and that then takes an enormous amount of time to close those deals and get them over the line. And so, I would look at it and say, unless you have a significant strategic partner, you have to take a phased approach. It doesn't matter how big your resource is. It's great to have a billion tons of ore, but if you can't finance it and build it, well, it's just value in the ground.
So, what do you think when you see these companies, sub $100 million market cap companies, sub $50 million market cap companies coming up with a $1 billion capex? with an NPV of goodness knows what. Do you think they are deluded? Are they old school? Are they going to get the shock of their life? And what do you see either as a CEO of a company or as an investor? How do you view companies like that?
I think from my perspective, there's a natural tendency in running a company to want to have the biggest possible headline number because you think that that's going to be beneficial to get people to buy in. But the market cap is telling you that the market doesn't believe that you can finance it, is my view on that. And so if you want to change that, you have to change your strategy and you have to change your approach in order to attract the capital that will allow you to go to the next phase of development. So I think they do have to have a look and say, okay, well, the market's not believing what we're saying today. We've got to have another think about this. Is there another way that we can do it? And that's Hugh's point, which is a phased development approach. Okay, naturally the NPV, it's not going to be the most optimum return on invested capital and the most optimum NPV, but the best return for your shareholders is the one that you can actually finance and move forward.
Yeah, just to add on to that point, I think it's really it's really important to remember that it's not just the capital cost of these projects, it's to get to the point where you can turn a shovel and actually spend the capital to build the projects that often is the hurdle here. And further to that, it's not just the quantum of money, but it's where it comes from. So what you're seeing is a lot of these companies with big development costs in front of them, leaning on the what I call public private equity companies. That is the royalties, the streaming providers, and that's not necessarily the best money on an uncertain timeline to construction and free cash flow. You don't want to be borrowing money effectively and leveraging the house when you don't know when you're actually going to be able to repay that money. So that's just one of the challenges that comes up from pursuing a very big project and a very big development capital burden with something other than equity and something other than long-term equity. So those are the kinds of challenges we face in our industry. But I think it's really important, and listeners really need to cue into this, which is what Hayden's saying about scale. Having big scale and exploration potential for subsequent phases isn't the same thing as saying you have to build the $1 billion project right off the bat. And not every project will allow that to happen. Only certain projects you can pursue in that manner. Some big, large open pit with no possibility of changing laybacks is going to have to be big right off the bat, or one that requires large throughput to justify economics in a difficult location. I think in the case of Marimaca, you're not far from the ocean. You got access to water. You have low elevation. You don't need to build a big facility or a big power plant or infrastructure to be able to facilitate production of free cash flow, which is ultimately what investors get rewarded with.
And I think one of the things that I have thought about was, trying to right size a project for what I believe we can finance in the market. And I don't know whether that's ever crossed your mind, but for a $500 million company, I look at it and go, okay, so our logical financing size without diluting our shareholders to nothingness is $500 to $600 million. If we're starting to talk about financing more than that, then we're starting to get to a point where if our existing shareholders can't follow their money, they're going to be really suffering a lot of dilution. Has that sort of thought process ever gone through your mind as you think about the development strategy for your projects?
Yeah, and I think that's a really good point. And also aligning yourself with partners that, will mean you can get there. So whether that's the Greenstones of this world in your case, or in our case, Dundee Corporation recently coming in with a strategic stake and an ambition to do a lot more with us. So those are the kinds of things that I think separate us from others, really, and allow us to get these projects going, but have scope for much, much more.
I mean, I think often with strategy changes come risk, but this seems like a no-brainer because the market's telling you loud and clear, we're not here if you continue down the previous routes. We're not risking money in a space like this, and that's come through some pretty big cock-ups in the space, where either through the economic study phase, the build phase, and even the operating phase. Do you think that generalist money will be encouraged to come back when they start to see these sorts of de-risk strategies that companies are employing? I mean, I'll stick with you, Hugh.
Well, look, here's the reality. In the case of the gold industry, the aggregate market cap of the global gold industry is about $0.7 trillion relative to the global oil and gas industry at about 10 times that size. Or take, for example, NVIDIA or Apple, which is about 5 times that size. The entire global gold industry, public gold industry. So we're a really small part of the overall mix. And if you look at the overall trends in investing, it's gone to passive money. We've got some 13 or 14 trillion dollars in passive money now now matching the amount of actively managed money out there. You have to be bigger in market cap size to be more relevant, and that means asset size, and obviously, that's an important factor for cost of capital. So I do think there's a move towards making structural or corporate adjustments in our industry to address that, but you can still get there in a stepwise fashion. And in fact, there are a lot of family offices, a lot of private equity capital, a lot of institutions that are still looking for, first and foremost, ability to make money on their investments. And then they'll chase, we'll find all sorts of generalists chasing passive, larger market cap situations as we grow.
And I think those private investors are also, in my experience, slightly longer term investors. And as we know in the mining industry, having a long-term horizon is the way to make money. You can get lucky in the short term, but one of the challenges that we face with a lot of our sort of institutional partners is they are driven by their quarterly performance. And so, if you have a hiccup in the commodity price or a delay in your project or any of those sorts of things, you can go out of favor pretty quickly with those investors. And I think on your point on the passive investment, look, we've recently done a dual listing on the ASX. I, as a general rule, hate dual listings because it just adds complexity and costs and all of those things. But a big driver for the reason for us doing that was exactly that structural shift that you talk about, Hugh. We were reviewing where all the money had gone to, and it had gone from something like 15% passive money to over 50% in the North American market. And when you're a junior mining company, you need people who can take outsized risk positions as we go through this next phase of development. And there's just not that level of money available. It's slightly different in Australia. There's still pockets of money that can take outsized risk positions. It's not perfect. There is more passive money flowing into that market, but I agree with you completely that passive money is a real problem, especially at our end as we go into the the riskier phase of development.
Hey, tough for a Canadian to admit it, but there's a couple of things that the Aussies get right.
Let's come back to the strategic investors, because I think it's important to try and understand if the competitive tension is there, and are you guys getting the best value? Like, the money's there. It's really a question of the cost of that money. Do you think that there's enough competitive tension out there, which means that you're able to maintain some degree of control over those negotiations, or is this a last desperate act?
Yeah, from my perspective, competitive tension is a function of how well you go out and network and find the pockets of capital. Hugh's mentioned a lot of these pockets of capital. They're not easy to find, and you have to work hard and wear out the shoe leather, as I describe it, to go and continually meet these people and pitch the idea and also gain credibility with them. And that's kind of what's happened with Marimaca. It was a long, hard road, but we've now found several pockets of capital, which in many cases I'd never heard of until I met them. So, I think it's about the hard work of the CEO and the senior management team getting out and continually looking for new investors who are aligned with your strategic vision.
Yeah, no free lunch, certainly not in a down shift of the cycle for equity capital. That's changing, I think. Gold industry is delivering some $5 to $7 billion a quarter in free cash flow on RBC's numbers, and that's going to recycle. It recycles as share buybacks. It recycles as investment in the pipelines. I think it doesn't matter whether you're looking at copper or gold. The pipelines are pretty bare. So I think the money will come, and it's about preserving your capital structure, advancing your project as best you can. The good news is, it means you can get A players, high quality people, high quality consultants, and that makes for a better work product in the end. We all are challenged by people and availability of consultants. I I think this is one of the things that's a silver lining here.
Okay, well, let's move kind of like from the kind of the theory into the actuality. You know, like say there's a new reality for both you and other people who've been kind of smart enough, like you, to adapt to market conditions. So it's a sort of, say, challenging market out there. But as you kind of change the focus of the company into maybe these kind of nearer term revenue stories with this phased approach, the people in the organization need to evolve and change, or be replaced, or you need to make additions. Does that add additional cost, stress, and what's that transition look like? I mean, Hayden.
I say regularly to people that the biggest concern that I have is finding the right people and putting them in the right roles. And actually, I think a large part of my job is to find the right people and put them in the right roles, so that I don't have to be in the detail, which is not efficient and not helpful to anyone when I'm, pulling apart the detail on things. And that is a real challenge. It's not a big industry. It's a quite a small industry. Hugh and I obviously know one of my colleagues very well. It is really hard to find and attract good people. And when you find them, if you're not quite ready, you're best to jump on them and get them into your team ASAP, even if it's ahead of time, in my experience, because it takes a long time to get the right people.
Couldn't agree more. Yeah, couldn't agree more.
That's what the producers said as well. It's tough. It's tough out there. Maybe not enough young kids doing the right courses and joining the sector. Is that going to change?
I think it's going to change. It's interesting. I was chatting with a young fellow 2 years out from the mining program at Queen's University here in Canada last week, and he said there were something like 70 kids in the mining program there this year. Might have the numbers a little bit off there, but that's 5 times what it was just a few years ago. There's great opportunity in the mining industry, the modern mining industry, for young people who are interested in not just the technical sides of a work career, but the impact on the world and the ability to actually make a difference, travel, working in different locations, and having the opportunity to actually be part of environmental change, be part of the transition economy. Those things I think are really appealing to young people, and I think there is a good outlook. In the United States, the U.S. government is now going to reinitiate sponsorship for mining schools, because there's a recognition that domestic mining is an important strategic industry. I know Australia and Canada have always done some aspects of this, but gosh, when you see the world's biggest economy seeing the appreciating and putting its money where its mouth is in respect of the domestic mining industry, that's a good thing.
I remember maybe several years ago having the conversation with my family in Australia, and it was very much mining is bad. It's bad for the environment. And, the argument of, well, point to some part of your life other than free thought that's not touched by the mining industry, didn't really work in terms of having an argument. But it feels like the wind has changed and this pendulum is swinging back, and mining is no longer a dirty word. And I think that will allow younger people to start studying. And in fact, we have an intern working with us now at Marimaca, a young guy coming out of university, wanting to get into the mining space, contacted me out of the blue. I thought, well, why not? I'll give you a chance. I've had actually several young people calling me out of university saying, how did you get into the mining space? I'd love to follow a similar path. So I think there is definitely a change occurring, but it's like everything, it's a cyclical industry. So right now we're going through a phase where people are suddenly realizing that mining is incredibly important for everything that we have in our life.
Yeah, it's an interesting time, isn't it? We've come out of this, well, not if we've come out of it, we certainly have been in for a while, this kind of financial realism, this kind of capital constraint environment. But how do you got to remain positive. So, but that requires some kind of disciplined optimism, where you can talk about growth strategies, when you can talk about young people entering the space once again. I mean, how's the mood within both your respective boards? I mean, are people kind of quietly optimistic?
Well, I think from my perspective, what's happening in the US with Trump's tariff wars and trade wars is certainly causing some concern. I don't think it's a long-term concern. I think there's a recognition that it has to at some point reach a conclusion. But the question is, he hasn't been exactly predictable in his approach. So I would say, other than that, yes, we're very comfortable and optimistic about the future of our company and the future of the industry. But the short-term volatility is definitely causing us a moment to pause, and has caused us to defend our balance sheet a little bit, just to make sure that we're not forced into a deeply dilutive capital raise at an inopportune time.
Yeah, that's prudent. I mean, I think probably, both companies have pretty seasoned boards, that have been through the cycle a few times. I reflect back on successful companies like Tech and Agnico, and I really think one of the things that's in the DNA of these companies is an understanding of the cycle and a recognition that there is a cycle, and we do have to strategize around those cycles. So if you're Tech and you buy coal assets in the middle of a financial crisis, you're going to go through a period of time where there's a restructuring of the balance sheet, and you either stick with management and deliver on the long-term plan, or you throw the baby out with the bathwater. And if you've got a good board, if you've got a board that's been through cycles, they know how to adapt. As Hayden's talking about this tariff volatility. I agree. It's going to be something that's short term, but it is volatility, and we do have to work around it and play for the longer game.
Right. Well, what is happening actually? So I'm going to skip away from the operational side of things and into kind of back into the markets a little bit, but specifically around gold and copper. I mean, do you guys face different headwinds as a result of what's going on out there? I mean, it's obviously gold's gone on a tear. Copper's made a kind of modest recovery from last year. How do you feel about the gold market at the moment? Is that high price reflected in what you're doing, your new strategy, Hugh?
Look, you have to look no further than the reserve price that the industry leaders are using to understand what's happening in the gold business around these high gold prices. So those reserve prices and probably the mine plans around those prices are down at $1,400-$1,500 an ounce gold. Half of where the price of gold is, less than half where the price of gold is today. So the shorter answer is no. The industry, there isn't going to be no big supply response to these high gold prices. I don't see that happening. I don't see a change in tactics in terms of M&A. I don't see overinvestment. Not yet. Not for a long time. It may come. And the same is probably true in copper. I mean, there's a lot of industry discipline, and so there will not be a big supply response to this price level. Do I think the price of gold has run? Absolutely. If you look at it compared to copper, you would absolutely be buying Marimaca shares today rather than Revival Gold shares today, because the gold price has run. There's no question about it. But in terms of what the market is discounting in the shares, I think it's way south of where we are in the spot market, way south of the spot market. I mean, you can check in with the analysts that cover the stocks, but I'll bet it's down around $2,200, $2,500 at most in the gold space, and similar discounts in the copper space. So either way, there's a lot of value in these developers, and there's a scarcity of new projects. And I'll go back to my earlier point, which is there is not going to be a supply response. So don't expect the prices to violently turn down from new supply anytime soon.
And I wonder whether a few years, I remember when I was in the gold industry, sort of 2010 to 2014, there was obviously that tail off in the gold price. Gold price ran, I think, to $1,800, maybe $1,900 an ounce. All of the companies had revalued their reserves, redone their reserve calculations on a $1,600 or $1,700 gold price, and then the gold price collapsed, and they all had to take big impairments at the following, annual report, because they had to adjust their gold price down. And I think there's been a lesson learned by the industry in that. It's great right now, and we're making a lot of cash, but just as quickly as the price is up, it can come back down to a more normal level, perhaps to say.
Whatever that is.
Yeah, whatever that is. I mean, I love when people ask, well, what's your forecast on copper price? I mean, I don't know. I think it's, certainly there's a floor in the copper price, but I don't know how high it could go and how long it'll stay there. Copper is slightly different, I think, in terms of supply response. If the copper price runs like gold has, then I think we would start to see some of these bigger projects owned by the majors getting sanctioned and moving ahead. So that would naturally cause a reasonable supply response. But I'm not sure, given the change in structural demand, that the supply response will ever be big enough based on what I'm seeing in terms of global structural demand changes.
And those are big investment decisions, right? Those are multi-year. I mean, you as a leader of a large copper producer would have to have, a 4 or 5 or 10-year view on the metal that was, significantly higher than where we are today to make some of those investment decisions. Those are multi-billion-dollar investment decisions, and in a lot of cases, in more difficult
jurisdictions
than Chile.
Yeah. Yeah, well, Gary Nagle said that in order to greenlight some of his copper projects, he would need $15,000 a ton copper. Now, he probably is talking his own trader book, but I think it's not far wrong for many of the other CEOs in similar positions with very large scale copper development.
That'd be nice. 15,000, nice. Okay, so I think what you're saying is the market views, the psychology of it is the market views copper as a future-facing strategic metal and gold as a hedge, but as the geopolitics changes, I see the Chinese and the US or in Switzerland having a chat about tariffs, etc. When things kind of settle down, do you think that the current view of the market is going to hurt your respective equities in the current market with the current market conditions and what may be? Hayden, how are you reading it?
Yeah, look, I think I've been surprised at how well copper has held up, frankly, considering the data in the US in particular is pointing to a recession being very likely at some point during the course of this year, and the contraction in the first quarter. There's a genuine concern on my side about how long that takes to play out, even if these trade agreements are formalized and ratified in the short term. But I think I went to China for a week a couple of weeks ago, and I have to say I'd read all the data and I'd been reviewing all of the information about what was going on in China and the record amounts of copper they're demanding, despite all of the well-publicized and documented woes. And what really struck me is there is a new infrastructure boom that is going on there, and that is very much focused on electrification. And so I think the structural demand has changed. And I think that structural demand has not yet taken shape in the more developed economies outside of China, like the US, like Europe. We haven't been investing in electrical infrastructure. And what I know is the amount of electricity being demanded, not just because of AI, not just because of data centers, but just in general, is going up an extraordinary amount that's going to require a significant amount of infrastructure investment. So I'd say I'm optimistic that the copper price will remain relatively strong. Yes, there'll be volatility. I am concerned about the short-term implications of what this tariff trade wars have caused and how long that will take to shake out. But I think the underlying fundamentals from my side are really good. And I think that actually benefits gold as well. I say the uncertainty is very beneficial. And so for the first time in a long time, I'd say you can own both gold and copper and probably have a valid investment thesis for both.
I think that's right. I mean, the bottom line is there are not enough of these development projects in good locations to feed future demand, and spot price may move up and down, but these projects are rare, very rare, and in good locations, rarer still.
Yeah, I mean, if I look at sort of capital efficiency and value multiples in both metals, it's kind of clear that the need for the quality bar to rise for developers is going to be critical for companies to kind of survive, get the funding, be able to move things forward. I mean, it's sitting around waiting around for $15,000 copper. Not sure that's a brilliant strategy. Someone's losing money between now and then. So we shall see how the sector plays out. And so, do you think that kind of whatever the metal, most of the problems that you face are similar, or does it all come down to metal price because that will be the arbiter of success or failure?
I think the challenges for running a junior mining company, obviously some of them are location specific, but in general, the challenges are very similar regardless of which company you're working with or which project you're working on. the overarching issues that you face are, one, a source of capital, and making sure that you're not diluting your shareholders at inopportune times. But I'd say most of the challenges you face are very similar across the board, with some slight nuance depending on commodity and depending on location.
Yeah, capital and people.
Capital and people, both good capital and good people hard to come by. So what I'm hearing from you guys. I mean, just to kind of round out in terms of what you think the most important things that investors need to be looking at when considering investing into companies at the moment. What would shape your investing strategy? What should shape their investing strategy? I mean, Hayden, do you want to go with that?
When I look at companies that I invest in, number one, it depends on the stage of development, obviously, but number one, it's somebody who I have known and followed, and has had some level of success in some shape or form. It's not necessarily that they're always going to be successful, but if they've had success and have learnt, through the hard scrapes of running a junior mining company, that's a good indicator that they'll certainly be somebody that I'd want to back. I think one of the big ones for me is just being careful with capital and not spending money. So I'm always wary of junior company CEOs that attend every single conference on the conference circuit, and flying, around business class and staying in very nice hotels in New York, London, Hong Kong, all of that is a red flag to me, because at the end of the day, it's shareholders' money that we're spending as we go around and do that, and there has to be value add for doing those sorts of things. I typically, at our stage, I like to see, maybe not necessarily a strongly technical CEO, but somebody who is less focused on the exploration side, and more focused on what is required to go from a development stage project into production, because it is a very different skill set and a very different mindset. It's not to say it's impossible. There are, numerous examples of geologists like Clive Newell, who's on our board, who have been exceptionally successful in developing projects, but it does take a completely different mindset in order to do that. So those are probably the things that I would look for in the first instance before I even get into looking at a project in detail.
Yeah, and I think I agree with all those points, and would just add one, which is capital structure, financial backing. So I think, again, if you look at the firms that are behind these companies, you want to see knowledgeable, capable, long-term investors that are aligned with you, that are going to ensure that these projects are carried forward, right? So, and delivered on.
I think those all good points, and it's quite easy to kind of spot the CEOs and the boards who are kind of drinking the Kool-Aid. They're pushing something which just doesn't make sense, and I think sometimes you need to kind of follow your gut and maybe call out some of the I guess more aggressive, more enthusiastic strategies, because the risk in this space is big, and you want to see companies that are kind of set up for both the up and the downside. Certainly for me, we like conservative teams, realistic teams, but based on fundamentals. Chaps, I think that's kind of good conversation about that kind of. It gives an insight into the way that you think about these things, which I think most people don't get to see. So I appreciate your time today. Thank you.
Thanks.
Thank you, Matt. Yeah, good to spend some time with you, Aidan.
Yeah, you too.